Hello and welcome to Global Research Unlocked, where we discuss what's rising from growth industries to rising risks and opportunities in global markets. I'm TJ Thornton, Head of Product Marketing at BofA Global Research, and we're recording this episode on Friday, July 10, 2026. Every month, the Bank of America Institute publishes the Consumer Checkpoint. Note that the Institute is not part of BofA Global Research. The report offers a look at the prior month's aggregated credit and debit card data, highlighting trends and inflections. The checkpoint often integrates other proprietary data too, from ACH to direct deposits. The report and other Bank of America Institute material can be found on our website. Today, we're talking to David Tinsley, senior economist at the Institute, about the latest data, which is perhaps even more interesting than usual, given it shows an apparent narrowing of the K-shaped spending dynamic, as well as the impact of the 2026 FIFA World Cup on spending. Thanks, David, for joining.
Pleasure, TJ. Thanks for having me.
So what's the headline from this month's Consumer Checkpoint?
Well, I guess the main headline is that consumer spending in our data is really astonishingly strong in June. The credit and debit card spending, which is drawn from Bank of America's upwards of 70 million consumer accounts, shows spending of 6.3% year over year in June. And to put that in historical, perspective, that's the strongest in 4 years. I think it's just worth saying that spending has been very good all year. So even at the start of this year, January, February, we were talking about sort of 3-4% rates of growth, which was pretty good. But right now, it's really exceptional, I think.
David, what's driving that strength in spending? The squeeze from higher gasoline may have eased a bit from a month or so ago, but gasoline prices are still up over 20% versus a year ago.
Yeah, you're right. Gasoline prices came down. I mean, they came down a decent amount really in June. And when you look at necessity spending in our data, across income cohorts, actually, that did come down. So the story on the month, and total card spending rose 0.6 on the month. The story is all really about increasing discretionary spending. And I guess one of the things that's happened over this year was that really over the last couple of years, discretionary spending was almost exclusively a kind of services story. And in the data right now, we do still see very strong growth in services. The airline up over 10%, leisure spending up over 10%. But we also see in this data something of a kind of comeback on the retail side, clothing up 7%, gen merch up 5%. So if anything, this discretionary story, I think, has broadened out a little bit from just being about experiences.
Okay, and I talked about the World Cup at the top, especially earlier on in the FIFA World Cup. There were a lot of games. Is there evidence to suggest that really contributed to these strong spend numbers?
Oh, I think so. Most definitely, really. I mean, essentially, when you look at the data and you look at it up to the start of the tournament around June the 9th, and then after the start of the tournament, in total card spending, you see a jump from about 5% year over year over that period to 6% or so when the tournament starts. Obviously, food and drink being a focus, that showed a rise of over 1.7 percentage points between those periods. I do want to make one point, though, which is, of course, online retail promotions. Usually, they tended to be in July. Well, they were in July last year anyway. They were brought forward. So this spending blip or this spending surge in June is not just a World Cup story. There's also a kind of year over year comparison story when it comes to online too, doing some of the work here.
Understood. And yeah, I guess maybe because those promotions came earlier, I totally missed them, which is probably a very good thing. But just back to the World Cup. I know we look at both cities that hosted games and those that didn't, and even cities that didn't host games, could see a boost from people going to bars and watching games. But do you see much of a difference between those that hosted and those that did not?
Yeah, we do. So we've divided the sample into, as you say, really World Cup city hosts and those that aren't. Essentially the residual, and then just to give you some data around that. We saw host city restaurant spending rise 6% year over year after the tournament began. And before it was running about plus 3%. So that's a 3 percentage point boost. For the other places, we're seeing a marginally positive boost, about 0.3. So there's a big jump, particularly around restaurants and obviously bars, because I imagine beer drinking is a good part of this story. And then just subtler increases in areas like retail, brick and mortar retail, and overall in total card data too. I do want to make one other point, which of course is, as good as this data is, it is focused on US consumers. It's a US domestic story. So what we don't see in these host cities vis-a-vis the others is the foreign tourist impact. And that's a harder one to calibrate. I don't think we have any reason to think that has disappointed. If you look at TSA data, relatively flat between people coming through the airports in the US between this year and last, maybe down a little. So hotel data, I think, modestly showing a rise in occupancy rates last time we were looking at it. So I think, the foreign increment is also likely to be boosting these city numbers too, these domestic US consumer spend data too.
Understood. Okay. K-shaped economy. It's gotten a lot of focus over the last couple years. People have come to accept this idea that higher income folks are spending and lower income folks are not. But I know that over the last few months, you've seen a bit of a narrowing in the K. So what exactly did we see in June on that front?
Yeah, this narrowing in the K is not really what we expected to see. So, over the last about a year and a half, say, we saw this ballooning out in higher income spending being growing and increasingly growing faster than mid and lower income spending. And that gap got, sort of 2 or 3 percentage points at times. Over the last few months, we have seen a narrowing in this K. So higher income spending growth was still solid in June, but it was growing around 5.8%. Now, lower income spending growth in June was growing about 1.8%, but that has picked up from 4% in May and way below that in earlier months. So the K has actually now narrowed between higher and lower income spending growth in our data. So the narrowest it's been since May 2025. And you see that in discretionary spending too. And just one other point, which I think is important, is that, from a macro perspective, lower income households contribute a relatively small amount of overall consumer spending. One of the Institute dailies recently highlighted that the top 10% of households by income, their share of discretionary spending, I think, was around sort of 7 times that of the lower income household. So, the economy is by and large driven by higher income households, but I don't think you can afford to lose middle income consumers. And we have seen some signs that middle income spending growth has converged on lower income spending growth. At the moment, that's in an upwards direction, so it's not too concerning. But I think that is something to watch, that convergence.
Okay, understood. An interesting point about the disparity and just how much more important the higher income is for overall spend. But, I'd also point out that for certain companies and certain segments of the market, lower income is important. We had our Staples analyst on the morning call this morning talking about that very thing. And if there is this sustained improvement in the lower income, that could be quite good for certain staples, where, it really is kind of a volume game. But on that point about improvement in the lower end and whether it can sustain, I mean, what explains the improvement so far?
Yeah, I think there are sort of 3 points to make here. One is around World Cup, where when we go back to that data on host cities and the impact before and after the World Cup starts, and then we split that by our income cohorts, which just for reference is splitting the data by thirds in terms of the income distribution. The biggest bang for the buck has come from lower income households boosting their spending growth. So if you look at restaurants, for example, the lower income consumers were spending year over year rates of greater than sort of 8% relative to last year in terms of restaurant spending, and middle and higher is less than half that. So I think a bit of it is down to World Cup, but by no means all of it. And then there are two other things that I think we really need to focus on. So the overall story we're seeing in our data is that wage growth for lower income households is picking up, particularly this after-tax wage growth measure the Institute looks at, because we see the payroll coming into people's bank accounts. So we see it after deductions, any deductions their employer makes. And just to give some numbers to that, really in January, in our data, these lower income households were getting wage growth, after-tax wage growth of about 1%. So pretty low and obviously below headline rates of CPI. We have seen over the last few months that accelerate as of June up to 4.1%. At the same time, higher income wage growth has come down a little, not as much as the acceleration at the bottom end. And now the wage gap between higher and lower income consumers is more or less closed. And there was so we sit back and we ask ourselves, now what's doing that improvement for the lower income consumers? And will it last? Because obviously this matters for the second half of the year. And we can kind of see two reasons potentially. One is around tax withholdings. So because our measure is an after-tax measure, it's possible that lower and middle income consumers have reduced their withholdings at the start of the tax year, possibly because of the stress they were feeling at the time over things like high gas prices, etc. And that would have boosted their take-home pay. That could be one of the stories. And then the second one, I think, is around labor market in general. And this is, in a sense, the better news story. This is the one that says, well, look, we've had good payrolls growth over the last couple of months, a bit less so in June, but by and large, an acceleration of where we were at the end of last year. Other labor market indicators look relatively solid. And even within Bank of America data, other indicators of the labor market we follow look good. So in a way, I think that's probably the one you want to pin your hopes to if you want this K-shape spending dynamic to really continue to narrow in a sustainable way. The jury's a little bit out at the moment because it's quite hard to discern between those in the data.
Okay, understood. And of course, that's that improvement in the labor markets is one of the reasons why the market and certainly our econ team are looking for hikes, Fed hikes this year.
Right.
But you guys also do a separate monthly piece on labor markets that was out earlier in the week. Any additional insights from that you can share about just the overall labor market?
Well, what we do in that, we start off doing that at the front every month, is we essentially look at an estimate of payroll growth based on jobs growth based on our account data. So essentially what we're doing there is we're counting the number of paychecks we can see going into Bank of America customer accounts. And in that data, it has remained, very solid. We saw a deceleration in jobs growth, rather like you saw in the BLS data through the end of last year, and then a really aggressive kick up in terms of acceleration in jobs growth in the Bank of America data through to June. I think it was up 1.7% year over year in June. So it has to be said that that's considerably larger acceleration than we've seen in the BLS data to date. But, directionally, there's a consistent story there. We did one of the things people were asking us when we published on that data in May was, could some of this be due to World Cup hiring? So in the latest report, we cut our data by cities that are hosting games and cities that were not. And by and large, you see an acceleration in jobs growth in the cities that are hosting games and an acceleration in jobs growth in the cities that aren't. So it's not obvious to us that the labour market improvement is a kind of World Cup story, even if some of the spending data is. And then I suppose the other insight, which I was referring to earlier, really was around job changes. Relative to last year, we've seen an acceleration in the number of people who are moving between jobs, straight between jobs, job to job changes. And that's quite an important driver potentially of the narrowing in the K-shape for wages, because when lower income households move between jobs, they typically get a 10% plus raise, partly because they tend to be younger. And when you're younger, when you move between jobs, you typically get a larger raise. For middle and higher income households, the raise is typically lower. So this pickup in job to job changes can also be driving some of the improvement in the wage K, I think. And again, that's a good news story. If that continues, that speaks to some persistence in the narrowing of the K.
Understood. Yeah. And I remember, during COVID or just after COVID, that was a big driver of wage growth, was all this job switching. Of course, what we're seeing now is not nearly what we had seen back then, in terms of the percentage of people switching. But to your point, it's at least off the bottom, and that's helping. Okay, so a lot of good things, mostly good things that you talked about, with some concerns, but generally, are there other things that worry you about the outlook for spending and for labor?
Well, I don't think we should be too concerned over the next few months if we see a pullback in spending, both in year-on-year terms and potentially month-on-month, because we're going to see the World Cup effect drop out. We're going to see this online effect going to reverse, particularly in next month. So we are probably going to in for a slightly choppy period of spending growth. I don't think we should let that blindside us from the kind of underlying picture of decent momentum. The one thing I would point to in our data right now is that across all income cohorts in June, households were spending faster than their wage growth was rising. So again, I think that does point to tensions. And I think you saw it in the BEA savings rate falling to a relatively low number. I think 2.7% from memory, something like that. So I do think there is some pressure on spending from the fact that it's been outrunning wages for some time. And I guess one other point just to make is, the first half of this year, well, back in December of last year, everyone was expecting the first half of this year to be pretty solid, because people were expecting bumper tax refunds, the World Cup, and there was lots of reasons for thinking this would be a good first half of the year. While there aren't that many headwinds in the second half, there isn't quite the same kind of list of tailwinds that you could kind of point to, I don't think, in the second half. Tax refunds largely run their course. The tournament's obviously over and stuff. So I think, there is a little bit of uncertainty there. But I think the outlook is broadly good and the labour market's in good shape. It's pretty solid still.
All right, David, thanks very much for joining us.
Thank you, TJ.
Consumer spending has been strong all year, according to Institute data, and actually growth further improved in June. The World Cup helped, especially in the host cities, which saw more of a boost. Between this every 4-year tournament and the earlier timing of online promotions, though, don't be surprised to see year-on-year growth decelerate over the next couple months. But the bigger story here is a narrowing gap in both spending and wage growth across income groups. Here, too, the World Cup probably plays a role, but improvement in wages and labor data also seem to be a result of improvements in labor markets overall. Thanks for joining.
Bank of America and B of A Securities are the marketing names for the global banking businesses and global markets businesses, which includes B of A Global Research of Bank of America Corporation. Lending, derivatives, and other commercial banking activities are performed globally by banking affiliates of Bank of America Corporation, including Bank of America N.A., member FDIC. Securities, trading, research, strategic advisory, and other investment banking and markets activities are performed globally by affiliates of Bank of America Corporation, including in the United States B of A Securities Inc., a registered broker-dealer and member of FINRA and SIPC, and in other jurisdictions by locally registered entities. Copyright 2026 Bank of America Corporation, all rights reserved.